Now that we've dealt with the supply and demand side of oil prices, the next key driver we need to consider for oil is inflation. As such an integral part of the transportation of just about everything, oil is also a leading indicator for inflation. This chart paints a very important picture for us by showcasing the strong relationship between something like WTI and US 10-year and 5-year inflation expectations. Rapidly rising or falling oil prices can lead to sudden changes in inflation expectations, which could affect bond yields and ultimately impact interest rate expectations as well. So for oil prices, the focus isn't just on the demand side or the supply side, but oftentimes more weighted towards what it means for inflation and inflation pressures. When it comes to the broader economy, severe supply shocks in energy prices can have devastating consequences for the global economy. Every recession since the 1970s was not preceded by severe oil shocks. Sometimes they were caused by something else. But it's worth noting that every severe oil supply shock has preceded a recession. As oil prices respond to drastic changes in supply and demand very quickly, a chart of the 6-month percentage change is a useful recession gauge. Since 1970, every 100% price gain on a 6-month look back has led to a recession within a few quarters. Oil and other commodity prices can greatly influence inflation expectations. But it's also important to realize that oil and other commodities can often be seen as a hedge against inflation. This means that sometimes commodities like oil and inflation expectations can find itself in a positive feedback loop where one influences the other. As commodities rise, we see inflation expectations rise alongside it. As inflation expectations rise, we see commodity prices in an attempt to hedge against that rising inflation expectations rise as well, which gives rise to further commodity price inflation and inflation expectations, and you get the picture. Now, even though commodities act as a leading indicator for inflation, inflation expectations can also be a driver for commodity prices, which is important to keep in mind. So even though commodities like oil act as a leading indicator for inflation, inflation expectations can sometimes be a driver of commodity prices itself. Taking a look at this familiar grid, we can notice something very interesting, but probably not too surprising after the info that we just shared. Notice that WTI is a very good performer during stagflation and reflation economy regimes. Now, what does both of these two economic regimes have in common? Yes, rising inflation, of course. This gives credence to the view that one of the best ways to hedge a portfolio against inflation risks is by holding the assets that are expected to appreciate the most in an inflationary environment. And that, of course, is energy and things like WTI. The risk, of course, is that the rise in inflation is so high, or the rise in oil prices is so high, that it leads to a recession, in which case we would expect things like oil to depreciate, as the historical evidence shows us that recessions have always been deflationary and bad for oil prices and other commodities in general. The other driver we need to consider for oil prices is risk sentiment. Now, commodities in general have a high beta and is usually sensitive to overall risk sentiment. But it's important to note that risk sentiment is arguably one of the least important drivers for things like oil prices, and supply and demand is usually the most important consideration. Looking at the average S&P 500 returns over the past decade, we can see that the correlation between something like the S&P and that of oil is about 0.3, which is no doubt a positive correlation, but not one that would be considered statistically significant. However, that sensitivity was measured on average S&P returns. When we only focus on the 0 to 1% percentile of S&P returns, in other words, looking at the worst of the worst performing days for the S&P in the past decade, we suddenly see that correlation pushing up meaningfully. This suggests that commodities like oil is very risk sensitive, but far more sensitive when equities have big negative return days. As a general rule, we always consider commodities as part of our risk sentiment analysis. But it's important to keep in mind again that oil can move in the opposite directions from overall risk sentiment if there's a strong enough supply and demand reason to do so. So as you can see, there's a lot to consider when trading the world's most popular commodity. And like most securities, it's never just one thing but a group of factors that we need to consider. It's also worth noting that the difference between implied volatility across assets such as WTI, S&P and gold is something to always keep in mind. On this chart we have the implied volatility for oil, which we can see in white, which is called OVX. We have the implied volatility for the S&P, which is called the VIX, which we can see in green. And then we also have the implied volatility for gold, which is called GBZ in blue. Now, we've merged the scales of these volatility gauges on the same axis to be able to compare volatility more accurate. And it's clear that oil has a much higher level of implied volatility to compare to that of the S&P and gold. It's very important to acknowledge this increased volatility because it means trading oil is a very dangerous endeavor without the proper skills and analysis. Yes, the volatility means that if we are right on the direction of travel, we could make a lot of money. But the knife has two edges, which means if you are wrong on the direction of travel, the increased volatility can also cost us a lot of money as well. So the bottom line is when trading oil, be careful and always protect your downside with proper risk management because this is a volatile one.